Hey everyone, welcome back to another episode of Stage Debate with Isaac. This is the last episode of the Stage Debate series for multifamily. It was an unbelievable series. We had some fabulous guests, great conversations, great sponsors, and we're up to the grand finale. We have some great guys on today. Alex Oliver, a good friend of mine, Vivek Kumar, a good friend of mine, and Scott O'Neill. So get ready, fasten your seatbelts. I want to give a tremendous shout out to our episode sponsor, Laundry Time. Laundry Time is doing some fabulous things in the space. You have many multifamily properties with rundown laundry rooms, and it's just not a good process, and people are going elsewhere. And it's definitely not attractive when buyers are coming in and looking at a rundown laundry room. So we have Laundry Time, which was founded on these principles to make the laundry experience something just spectacular. So folks actually do their laundry there. Owners can actually make money off of it if it's done the right way with Laundry Time. They have a revenue sharing platform, which everything's done online. So it's full transparency. No stone is left unturned. Folks coming to check out the property are definitely intrigued by the fact that, hey, we have a great amenity here. So brand new machines that don't cost the owners really too much at all. So Laundry Time are folks that you should reach out to. Let's beef up the property's appearance. Let's beef up the property's NOI with zero headache for you. They've worked with some big time owners in the space. You can be next. Thank you so much to our corporate sponsor, Michael Stern of Line Star Tax and LST Consultants. These folks are tax geniuses, collections geniuses. So if your property is in a situation where collections are down, you need somebody to come in, they have the system figured out. Leasing geniuses, they really are. They have helped owners get their properties leased up in a fast and efficient fashion. They're really good at what they do. I know many folks that have worked with them. Reach out to them. These folks will definitely improve your situation. Again, thank you so much to all our sponsors, our corporate sponsors. You guys, this was a tremendous ride. Obviously, we're going to get back to the multifamily series at a certain point, but after this episode, we're going to dive deep into the hotel series, and it's going to be exciting. So tune in, guys, for our grand finale. Let's go. Hey everyone, welcome back to another episode of Stage Debate with Isaac. We have some fabulous guests on today. I'm very excited about this one. We have Vivek Kumar, we have Alex Oliver, we have Scott O'Neill, all friends, some clients, and all have done some great stuff in the space. A lot of folks know you guys. I know a lot of folks that know you guys. So it's pretty incredible, especially in a market where it's not easy to get deals done. You guys have all done deals recently. You continue to do deals, and I appreciate the time that you made today to get on the pod and share your experience with other folks, perhaps that are stuck in this market, other folks that are perhaps starting out, to give them your experience and how you've done stuff and how you structure your deals. I'm excited. The audience is going to be excited. Let's hit it. Let's introduce ourselves. Let's start with Scotty O'Neill from FSO Capital Partners. Scott, give us a little bit of a background of what you are today, what you guys are doing. Fill us in.
Yeah, so I'm Scott O'Neill. I'm one of the principals at FSO Capital Partners. We currently own around 1,600 units, all in Arizona. We do kind of a combination of things. So about half of our portfolio is market rate, and then the other half has or had some sort of affordability component to it. And that's kind of the two verticals that we run.
And you guys strictly buy in Arizona, anywhere else?
Not currently. I'm traveling out of the state twice this month to go look at deals, so working on that.
Beautiful. Expanding our horizons. I love it. Alex Oliver, I had the honor of working with you recently. You're I call it a savage. You're a deal junkie. You just go after the deals, but obviously good deals. You're not just transacting just to transact. Give us a little bit of a background about who you are and what you do.
Yeah, so we're based here in St. Louis, Missouri. We've been doing all of our investing for the last really 17 years in St. Louis. So gotten to know that market really well, have a in-house management team, in-house construction team. And I think that allows us to still operate, as you mentioned, and some of the hairiness and challenges of today's market is that we're still able to, find deals where we're picking up assets that need work, need strong management, need a lot of improvement. And so we can bring that strength to the asset to close on it and still get the deal done.
Love it. Vivek, we know we have a lot of mutual friends. I've seen what you've done, continuing to do beautiful stuff, beautiful deals. You guys are based in the Alabama area. I like that market. I have actually a bunch of clients that buy in that area. Fill us in. Tell us a little bit more about you, your partners, and what you guys do, what you focus on.
So we're based down here in South Florida. We've been we had a portfolio in South Florida, and we've kind of been buying more so in North Florida and Alabama and Georgia and the Carolinas as well. So we've kind of expanded our footprint a little bit, as you know, it's been a little bit of a challenge in South Florida to find deals. So the deals are finding us elsewhere. And so we have about 1,000 units now throughout Florida, Alabama, and North Carolina. And
beautiful. Love it, guys. It's always cool to hear everybody has their markets that they're really on top of. Like, you probably know your backyards inside out. Scott, I wouldn't be surprised if you know the Arizona market literally inside out. Whatever laws they may have and just how things work and what makes people tick. And obviously there's inspections and so many things that each county and state and situation is different. But obviously the foundation of everything is very, very similar. I want to approach a topic. I've talked a lot on this podcast about the fact that things are different now than they were 3-4 years ago. And obviously we're not going to go on multifamily podcast without talking about that. But I want to shift the conversation a little bit more towards the actual pivot. Meaning to say, a lot of times in the past, I've brought on guests and we've talked about how things are different. Some folks are focusing more on loan assumptions now, whatever it may be, just to try to circumvent the issues. And obviously, like we all know, people that took out bridge debt a while ago, they're suffering today. They have to sell prematurely because they can't afford to refi at this and this rate. I want to talk a little bit about the pivot, and then after that, we'll pivot into other conversations. So, Alex, let's start with you. Obviously, you've been in the game. You didn't start yesterday. You've been in the game for a while. Right. 2020, 2021, even 2019, those were very prosperous years for many, many individuals. Obviously, there were advantages for you. How did you pivot once things really changed course? What did you start doing differently?
Yeah, so I think one thing we started looking at back actually in late 19, early 2020, was we actually started already considering what do we need to exit from our portfolio. So we really strategically were exiting second half of 2020 into 21 and kind of did our last couple sales in the spring of 22, getting in front of what I think we've all seen now of a really rapid rate changing environment and a much more volatile rate environment. So we, as you mentioned, we've been around for a long time. We had an older portfolio, stuff that really served us a lot when we were, I guess, younger and willing to do more difficult to manage properties. So we were really right-sizing the portfolio, I think, selling off stuff that didn't serve us anymore, freeing up some capital to strategically free up for targeting when, we kind of expected the market to be pivoting 23, 24, which I think we're now seeing. So that was what we did on the way in. We bought 0 deals in 22. We bought 1 in 23. I take it back. 1 in 22, and then 1 in 23, and now we've bought 5 in the last 13 months.
I like it, and we'll get into more of this later about transacting just to transact, because it really talks to me when you said that you did 0 deals at a certain point, because we all know that folks do get paid to transact. You get your AC fee. I actually was at a conference recently where a very honest client of mine, actually, he owns a bunch of stuff, maybe 4,000 units. He told me he walked away from a $1.2 million acquisition fee, and he felt it was a bad deal for his investors. And he said nobody would have known. Meaning to say he could have figured it out somehow, some way. And that's a sponsor that I want to invest in, right? So we'll get to that soon. But you actually mentioned something that I definitely want to hear Vivek and Scott's opinion about disposing of certain assets to use that capital to really strategically move forward. If things stay the same that were happening in 2019, 2020, 2021, if things stay the same, you might be able to keep those assets and be able to get crazy LTV on the new properties, and equity wasn't as tight. You don't have to dispose of those properties. So that really changes course. That's interesting. Scott, tell us something that you've done different and how you've pivoted. I'd like to hear.
In those run-up years, we really weren't utilizing bridge debt at all, if anything. And we started off really doing heavy value add deals here in Phoenix. And then that market got frothy. We went out to some more secondary and tertiary type markets like a Flagstaff or Prescott, for instance, and kind of alluding to Alex's point, we exited some stuff in 2020 and 2021 and reallocated that capital to, newer, nicer assets at lower leverage with long-term fixed rate debt. And then we've continued to do that. I think we've bought 4 deals in the last 2 years, all of them LIHTC, just because that's kind of the only thing that's penciled for us. We've worked on some of this stuff directly with a lot of these debt funds and trying to work different structures with A and B notes and, getting creative with rescue capital. It's proven pretty difficult. People, whether they're on the principal side or they're on the debt side, are obviously not too excited to take losses. I think I'm starting to hear more of that now. So that might be something that we continue to pursue into the future.
Love it. Very, very interesting. I like the LIHTC approach. Vivek, fill us in. What have you done differently the past few years? How did you pivot?
I think echoing some of Alex's thoughts, like we were selling some stuff more so than buying in like 22 and maybe 21 as well. And then I think in 23 we didn't do any deals. We didn't do any multifamily deals, and in 24 we bought 4 deals. So I think just I don't know about if we were really pivoting, but we were just kind of doing what made sense. There's a lot of offers that we received that were just, it was the right time and was a good price for us, and we decided to move on. And in 23 there was just nothing that really we could find that made sense. Even in 22 it was a challenge, and we're really open-minded. We want to be sold on stuff, so it's tough for us to not do deals. It really is. I think now finding deals that make sense, a lot of them that we've done have like some sort of a creative aspect to it, whether it be like a seller financing or just a different way of closing, or something a little bit different to kind of help it along. But none of the deals we've closed have really been easy, and you just have to kind of pivot and find a way to make it work.
So I think all 3 of us are kind of mentioning the fact that it's hard to get some of these deals done and getting to the reality of what the value is and willing to take a loss. I know I've certainly seen that several of the deals we closed in 24 we were chasing in 23. The price wasn't there yet, the seller motivation wasn't there yet, and they were hoping to get that price, or they maybe got under contract, the buyer couldn't close. I'm curious if you guys are seeing the same thing in other markets where the reality of the situation or the reality of the market is starting to become a little more real to sellers than what you guys had seen in the past.
Yeah, I mean, the last deal that we closed, we looked at it for the first time a year and a half before we bought it, and we had made our initial offer, and it wasn't the right time, or in that case the seller wasn't taking a loss, but they just weren't willing to move and execute at that price. And that deal, actually the last 2 deals that we bought here in Phoenix, were both similar circumstances where the seller eventually came around to that pricing. And then the other thing that I think that is going to get interesting here, given what's happened in the last few weeks, if these treasuries hold, is, we've had spreads have come in at the same time treasuries have moved 50, 60 basis points. And so that does a lot for you in terms of loan proceeds and obviously debt coverage ratios. And so I'm kind of interested to see if some more of this stuff kind of comes back around, to your point.
Yeah, that's something I've been seeing a lot is, as you were saying, it's just that timing. Isaac, you mentioned, walking away from acquisition fee. I think it's tough for all of us as growth companies and acquisition companies to balance that, but it is, I think, really important. I've seen a lot of guys that, aggressively get those fees, buyers in 21 and 22, that are now paying the price with, losing equity.
100%. Short-term vision versus the long-term vision.
We submitted an offer on this deal, smaller deal we're in South Florida back in May of last year. And like this week, yesterday, randomly, they just signed the LOI and sent it back to us. We're like, where did that come from? I was like, hadn't heard from them in months, and all of a sudden they're just like, yeah, we're good with the price. So
Wow, that's
things
interesting.
come back around. It's funny how it works.
No, that's a good point that you make, Alex. That, and I think Scotty said as well, and Vivek just mentioned that you could literally have been interested in a deal a year and a half ago, and finally the seller came down to a price point that made sense. And because of the market shift, things obviously changed. The seller's mindset is like, hey, am I really going to get what I want based upon what's going on with interest rates? Am I really going to get it with insurance rates? And folks are not as excited about Florida. Obviously, you have your niche in Florida, of course you do, but we can't deny the fact that deals are not easy to pencil because of insurance, and insurance has skyrocketed. Let's shift the conversation for a second. I love this, guys. Great talk. Trump gets reelected. Trump is president right now. Like him, don't like him, it doesn't matter. For me, that changes a lot. Obviously, 100% bonus potentially coming back for cost seg, and that's great. We're not talking about cost seg today. My question is for you guys. Trump being reelected, there's stability. You know what the next couple of years are going to look like to a certain extent. You know that he's all in for business owners, real estate guys. He's got a real estate head. How does that change your approach? Scotty, how does that change your approach?
Well, it depends on if he gets rid of that carried interest loophole, right?
Exactly. But knowing
But
him,
no.
he's all in for us. He's all in.
Yeah, no, I think having the 100% bonus depreciation back is obviously very nice. And for us, local in Arizona, Taiwan Semiconductor just announced another $100 billion investment, and they've got, $40 billion worth of in the ground, for the new fab facility to produce these chips for AI. And so you're starting to see more of that type of thing. And I think that you're seeing businesses start to be more comfortable making investments again. I think that that's going to take some time, obviously, to work through with the way that they're slashing government agencies, right? And so I think there's going to be some short-term pain for some long-term gain for the economy as a whole. I think on the long term, it's very positive.
I like the sound of that. I like the ring of it. Short-term pain for the long-term gain. You could coin that phrase, unless it's a phrase already.
I think it might be.
It might be. I don't know. Alex, how you adapting? Do you feel more secure right now making decisions in your real estate investment company based upon what's happening on the ground?
Well, I think it's a little bit of both. I mean, this is probably the case with any whoever's in office. It's what's the good, what's the bad. I've noticed in the last 2 weeks, equity partners and lending groups that I'm talking to are bringing up a lot more. Are you concerned about increasing costs of construction? Are you increasing costs of supplies, materials, renovation materials because of this tariff war? So that's been a bit of a negative. The potential positive that comes out of that is maybe there's more groups out there that do kind of get nervous and uncertain and put pencils down. And so for those of us who are still bullish and are still focusing on acquisitions, there's less competition. I know there was a deal I bought actually, and the one deal I bought in 23 came back to me because the original buyer backed away because Russia invaded Ukraine, and he freaked out about what was going to happen to the economy. He actually talked to me about it afterwards. He's like, yeah, I really panicked about the economy, and I bailed on the deal, and it came back to us.
Wow. But no, it's a lot of good points you're mentioning, is that obviously because of the tariffs, construction goods can really, really skyrocket. And there is that certain amount of uncertainty with how people will adapt to his policies. But again, could be it does give you that edge in terms of people putting their pencils down. That's interesting. I always say, and I'll just revert back to this, I'm a sales guy, and there's so many sales guys out there. And you have CPAs, you have attorneys, you have real estate syndicators like yourselves. I'm not a sales guy. Everybody's a sales guy. You're trying to win that. This is totally off topic for a second, but I just think it's amazing to look at it that way. You guys are selling your deal to investors. You guys are trying to get the broker to give you the deal and to take your offer seriously. You're trying to get the seller, if it's off market, to take your offer the most seriously. We're all salespeople. So the next time a vendor calls you up, by the way, since I started doing sales, anytime a vendor calls me up, now I don't know why vendors are calling me. Sometimes people call me and they're like, hey, you want to invest in our deal? Or they're trying to sell me any sort of service. I don't hang up the phone anymore. I'll respectfully listen because I know what it means to be a sales guy. We're all sales guys. We're all sales guys, each and every one of us.
No, you're absolutely right. That is the world I feel like I live in all the time. Now that we have so many closings going on, it's like, yeah, you're right. You're selling lenders, you're selling equity partners, you're selling the vision, selling the dream. It's a full-time job to be like, this is what we're doing. This is why it makes sense.
Exactly. And in a world, and that's something I want to actually venture into talking about now, in a world where equity is not as available as it was a few years ago, people are just writing out those checks. People are much, much, much less quick to just write that check. And obviously people are really deferring to sometimes preferred equity and to different avenues of how to set up that cap stack and really finish off the deal. Vivek, have you encountered that? Have you encountered a world where equity is harder to raise and you had to go different routes than you've done in the past?
I would say yes, it is generally harder. I think a lot of our existing group of investors, they'll come in, again and again, but they kind of have a limit as well. For new investors, it's been a challenge to bring in new investors. And I think part of that is like a lot of investors that I've spoken to recently, they've invested in a lot of deals and they're not seeing distributions. They're not seeing anything. They're not even sure if they're going to get all their equity back, at all, or maybe they take a slight loss, or they're really unsure about some of their positions currently. Some of the deals that we do are, I guess, a little riskier in that sometimes we take on bridge debt, we'll take on large renovation projects, and they're not cash flowing. Like where we tell, for a deal like that, we might tell our investors, you're not going to see any cash flow for a year. And investors right now don't want to hear that because they have too much money out there that's not giving them a return. And they want, from at least a lot of people that I'm talking to, they want cash flowing deals that will pay out, quarterly, at least something.
They're done with the idea of just not ground up, but like gut reno, and like they'll see a big return in 2 years. They want to see results today.
Yeah, exactly. And it's been a challenge and we're doing deals like that still. We're still doing the deals that are, okay, we need to gut renovate 22 units because they're down. And it's been a challenge to bring in investors for sure.
Yeah, that's interesting. I'm hearing a similar thing from a lot of my investor groups that they're looking for that. Hey, is this going to have a dividend? Is this going to have cash flow? Is this going to have something really right out of the gates? I think you're right that risk tolerance for a bigger payday, they're more looking for. Yeah, I get it may not as big a payday, but it's cash. It's cash coming back into the bank.
And Alex, tell me if I'm correct. This is just an assumption over here, but more than the actual check that you're going to get back in the mail via distribution, it's more that confidence that deals actually produce distributions versus the actual that $1,000 meaning too much. Does that make sense?
Yeah, I think so. It again, depends on every investor you talk to. Everyone's got different goals, but absolutely. I think Vivek hit on it with, your long-term proven track record partners that you've shown in, deal after deal after deal, you can produce results for them are going to be the ones that are going to come back for you. It's the new ones that haven't seen it yet that are more the, how do they get that level of confidence in a deal when, they know you, but they maybe been introduced, but they haven't been through a life cycle of a deal with you before.
But do you guys feel like conversely, because you haven't been deploying equity with the same veracity that maybe you once were, that people are also a little bit hungrier to see those opportunities from you when they do come along? Like the last two deals that we put out have required about 20 million in equity, and I was turning people away because we were overraised within 5-10 days.
Scott, I would love to have that problem.
Yeah, that sounds like an incredible Rolodex you got there, Scott.
I would love to have that problem.
I think that a lot of these people that when they see the approach, where you were disciplined when the market was hot and not taking on that high octane debt and running around doing a ton of deals to garner fees, I think that built up, a lot of trust with people. And so when they see stuff now, I think they kind of jump at it.
And I think there is some of that truth. I think people are looking for some, but I think the challenge is, like Vivek said, is it depends on your investor pool. If your investors are people that have invested maybe with others that were doing that rapid growth and rapid deployment, now they're kind of tapped and they're concerned, versus if they've been sort of exclusively with you or maybe hadn't been in the market before, they do have more liquidity.
No doubt about that.
Have any of you guys had to venture into the preferred equity space, whether it's option A or even if it's option B, for whatever reason? What's your take on the preferred equity game?
Of course, there are exceptions to every rule, but in general, if you are having to structure your deal with preferred equity, it's because your deal wasn't good enough in the first place. I would much rather be in the position of providing pref equity to some other group than to taking it on myself.
Yeah, I heard a really good analogy for pref equity. It's rocket fuel. It'll either take you to the moon or you're going to blow up on the launch pad.
I hear that. I hear that. Not bad. Vivek, I see that there's something brewing over there. Do you agree to this?
Yeah, I think generally most of the time, there's obviously exceptions, but generally speaking, most of the time, if you're putting on pref, it probably like it was just not a good enough deal, and that's why your leverage is low, and that's why you need pref, and it's usually that's the case. And I agree. I would rather be like we actually did a deal where we came in as kind of almost rescue capital, basically pref equity, and we were the pref equity, and we came in and took over operations, and so I like it more from that side. I would consider taking it, I guess, if I really like. You have to really believe, like if you're paying someone 14%, 13%, you have to really believe that you're gonna crush that. Otherwise, you're adding a lot of risk, and it can, you're putting your equity in a much
Well, and that's exactly it. It's so, like we're underwriting these deals to mid-teen IRRs. And so if you can go out and you can provide pref to another group, you're basically getting equity-like returns, but you're sitting in a much better spot in the capital stack. And so, obviously you have to look at those deals very closely, and especially in a rescue cap situation. But I would much rather be in those shoes than the one, taking the pref equity for sure.
Yeah, we've used pref equity sometimes, but it's typically on, more what Vivek was talking about, really deep turnaround deals where it's almost like a development type project. You do need to balance it. You can't stack too much of it, but there are reasons why sometimes then you do have a lower leveraged, senior debt. You then bring in some pref, and so you're still not stretching the deal too much. But if you're looking at a deal that's, got mid to upper 20s IRRs, you can sustain mid-teens pref and be fine.
Well, all three of you are in agreement that if I'm syndicating a deal, you guys are a limited partner, and we got some pref in the deal, that's an automatic eyebrow raise to look further in. Hey, what's going on here? Is that what you guys are saying?
Yeah, I think you should ask the question.
If I was an investor, for sure.
There may be a reason for it, but you definitely want to find out why.
Got it. Wow. So I'm on a call today. True story. I'm on a call today with a client of mine who lives in LA, big client, retail guy. And long story short, we're talking about a certain guy. I sent him as a potential investor. He had some 1031 funds. And he tells me like this, Isaac, I don't want limited partners that own a real estate and just want to invest on the side in somebody else's deal just for whatever reason. I want doctors. I want these guys. They don't know the first thing about real estate. They're not going to tell me what to do. So we live in a world where obviously equity is what gets us going. You know what I mean? Anytime you mention the word equity to any sort of syndicator, it's like, oh, stop, drop, and roll, right? What's your guys' approach to this? I've never asked this on a podcast before. What's your guys' approach to that? Obviously, the more deals you do, the bigger investor pool you have more of a say. But do you agree with this guy? Do you disagree with him? I don't think he's seeing this podcast, but even if he is, that's fine. Do you agree with him? Do you not want people in the deal that are going to just bog you down with all their questions? I do it this way. I do it that way. This is going to be a hot topic. A lot of people are going to want to see the answers on this one.
I will agree. I really am cautious with partners that are asking way too many questions at the front end. Look, how does this tenant pay this and make this happen? Like, you're getting way too in the weeds for an investment deal, man. I typically actually find that the opposite of it's not the seasoned guys who ask those questions. It's the very unseasoned guys who ask those questions. because they don't understand how real estate works. They don't understand they're investing in an investment vehicle that has a sponsor and a management team and a construction team, that's making this deal work. That if they're trying to get to that level of the weeds to understand the deal, I'm going to spend hours and hours for your, $100,000 investment. I'm not sure this is a good ROI on my time. Maybe you should invest somewhere else.
Agreed with Alex.
I hear that. Scotty, what?
I said agreed with Alex. Most of our investment group that participates on an ongoing basis in pretty much every deal we do has a real estate background. They've owned assets themselves. To Alex's point, they just understand it better. They get it going in on the front end. And I've found that those people generally, they're vetting you on the first deal more than they are the deal. And then they ask smart questions up front that I think any prudent investor would want to know. It's the unseasoned people that a lot of the time ask a lot of questions that it's not one of the main levers of the deal. It's not going to have a huge effect on the deal. You end up spending a lot of your time answering questions that aren't all that great or well thought out.
Vivek, are you with us?
Yeah, I don't mind. Like if someone is seasoned, it's actually, I think, a little bit easier to kind of walk them through it. You don't have to tell them the basics. And for me, it's easier to explain. So like a seasoned person that's new, it's easier to explain to them, I think, than a random person, a doctor or whatever, engineer, attorney, high net worth person. But that being said, like I welcome all comers. All comers, I'll walk you through it. I don't really care. I view deals as auditions for us. If they come in once, they'll probably come in again. If they come in twice, they'll probably keep coming again and again and again. So I view it as, I just view all these people, even if it's a small investment, as opportunities, and the lifetime value of that investor may be a lot higher than you think on the front end.
I hear you guys. The follow-up question I have is that very nice. You're right. Doctors need a lot more explaining than seasoned real estate guys. They know the game. They know the role. They know how it's going to go. But when there's a mistake that happens, right, for whatever reason, something happens, those seasoned real estate investors are going to hold you to it. Hey, why'd you do this and that? When it comes to the other guys, they're like, hey, they don't know their right hand from their left hand in terms of real estate investing. So I'm not saying that we're trying to blindside people and be like, oh, hey, I don't have to answer anybody. But in terms of everybody has a different approach. I guarantee you, all three of you do something differently, right? Nobody does the exact same thing. That being said, Scotty, you invest on Alex's deal. And I'm not going to use you guys in his example because I don't want to say anybody's going to do something bad. Somebody invests on somebody's deal. One syndicator invests in another syndicator's deal. And something goes wrong. They have to do a cap call, whatever it may be. For whatever reason, something happens. You're going to have the other guy saying, hey, if you would have done X, Y, and Z different, maybe this wouldn't have happened, right? You're going to have to answer those tough questions. And it's not just a tough question. Maybe this is the way I do things. And just because that's your approach, that doesn't mean that that's what I would do. I'm just saying that's just like the opposite side.
Yeah, I think what I like, so our first 10 years doing real estate, we didn't bring in outside capital. We did smaller deals, mid-sized deals. It was just what we could bootstrap and then, leverage that deal to do the next deal. I actually find I'm a better investor because I have seasoned investors as my capital groups, because they're peppering me on those questions on the way in. As Scott was mentioning, not the minutia questions that don't matter, but the fundamental questions. Hey, what's your plan on, the refi, the leverage, the, what's going to be your cap rate exit? What's your reserve plan? What's your contingency plan? What if, cap rates go up to, percentage points? What does this mean for you? They're asking material questions that are the big swings in the deal. And I find that since I have to answer those questions to them, it's sort of like having a little bit of a board of directors. It makes me a better underwriter. It makes me a better deal maker. It makes me a better, lead sponsor because I do have seasoned guys that are peppering me on the way in. So hopefully then that doesn't come up. Like you said, Isaac, why didn't you do this? Well, we talked about that before we ever got into the deal. We sort of were aligned. Yeah, I like your strategy.
I like that. What doesn't kill us makes us stronger. I always say LeBron's favorite championship, and I'm a LeBron guy, was against the 2016 Warriors. That was the hardest, right? You play against the hard guys, they're going to make you play tough ball, and that's what really builds you up. And I like that. If I was playing ball in front of all these NBA players, I'm going to play a different game than I'm playing in front of some friends. I like that. Listen, Alex, not everybody takes the hard road. Some people want that easy road and not have to face the hard questions. So I definitely respect that. Guys, as we near the end of the show, I generally do this, take a minute or two each guy. Really, and this was a great conversation. This was awesome. The audience is going to love it. Really take a minute or two each to give some advice to a new investor, to give advice to some other folks that potentially could be struggling in a market like today, people that have bridge debt expiring or just any other things that could be confusing. Insurance could be skyrocketing wherever they are in Florida. Some advice that you give to a new guy or to somebody else, a friend that can use your expertise. You guys have done it all. You guys have continued to do beautiful deals. Let's start with Alex.
I think I'll answer that two ways. I think for somebody new, I think the key is make sure your first deal isn't your last. I see a lot of new people that get really, really hungry. They want to get that deal. They're not as seasoned as underwriting. They're not as seasoned at a lot of the stuff. Sometimes they'll force a deal to make it work. And then they may end up being that guy that's now over leveraged and can't execute the plan. So just really make sure that when you're going into that first deal, you're thinking how this deal, Vivek mentioned with investors, one deal becomes many. When you're getting into real estate, one deal should become many. Don't stretch. That one deal could completely take you out. As far as people who are distressed, it's work it, man. The ones that I see that really go sideways is when it starts going bad, they get, I guess, sort of embarrassed or maybe don't want to call their partners, call their lender, outreach, figure out solutions that can make the thing better, even if it doesn't solve the problem. Ignoring it's not going to make it go away. You got to confront the problem head on. I've had insurance issues. We've had construction issues. We've had, you do this long enough, you're going to have issues, but you got to plow your way through them. That's the only way.
I love it. And for a new investor, somebody just starting out, obviously you talked about make sure your first deal is not your last, but in terms of even just creating that investor base and in terms of getting your name out, because facts are people are going to want to invest with you guys before a brand new guy. Is it partnering up with somebody that has experience? What would you say?
I think partnering is a great way to get started. You can then kind of be working with someone else's track record as well as learning from them. But even if you're, not comfortable with that and you want to do it on your own, it's just talking about what you do. It's building that network of, hey, we invest in real estate. I think one of the biggest advice I got when I was going from doing my own deals to raising outside capital is you're offering the opportunity for someone to invest. That's really the key when you're talking to people about your deals. It's offering an opportunity to invest. And if you're not offering it up, if maybe you are a smaller guy that's not offering other people a chance to get into your deals, to a certain extent, you're being selfish. You're not allowing other people to get real estate type returns that maybe don't have the bandwidth or capacity to do it themselves. They can come along with you and great investment returns using your knowledge and experience.
Love it. Love it. Just one thing I'll add. It's so funny. So in my house, if something's broken, I have to fix my door handle, this and that. I'm like, I can't figure it out. I'm just trying to shove it on. And my wife's like, Isaac, you're shoving it on, you're doing it wrong. So if you got to force a deal to work, something's wrong. And I love that. The deal doesn't go in. Obviously, you got to run the numbers and be creative. But if you got to force it on, such a great message. Vivek, just advice to a newbie investor or anybody else that's just struggling in today's market.
I don't know how much advice I have or how valuable it will be.
Come on, Vivek.
I would say focus on the fundamentals. How are you actually creating value? Besides, look at it from an unleveraged standpoint. What are you actually doing without any leverage? What does that look like, and how are you really adding the value? And I would say a lot of people starting out. It seems like to me, start out and try to raise a bunch of money and go do deals that way. I think the way Alex did it, trying to just put it together yourself and figure it out and learn on your own dime, maybe bring in another partner that knows more. Or I think that's probably the best way to start, is try to put as much of your own money in as possible and just figure out how to grow that and learn the skill of really creating value in real estate.
Love it. Love it. Last but not least, Scotty, what's your take? Give us some advice. Sorry, what?
I said I'll keep it simple. Understand what your margin of safety is. And so you need to understand, stress test these deals when it's your first deal, and then figure out what happens if rents go down 10 or 15%, if your vacancy's higher than what you're projecting. If you're going to use bridge debt or floating rate debt, figure out what happens if rates blow out and what your refi looks like, if your exit cap goes up, et cetera, and just kind of run it every which way and make sure that you don't lose money. You don't really lose until you have to sell. And so if you don't put yourself in that position, you can continue to work your way through the deal, and it may not turn out the way that you had hoped, but it will turn out better than if you had not gone through that exercise.
Great stuff. Listen, there's always a next generation. My friends, literally, they're just starting to invest, buying the first deal. One guy in Arkansas, one guy in Wisconsin, and it's scary. I have friends that approach me all the time like, hey, Isaac, you have a big network. You're a smart guy. I don't think that's so true, but why don't you syndicate a deal on the side? And I tell them all straight up, I'm like, to be honest with you, like right now where I'm holding, I'm a little scared. Like, I don't want to take other people's money. And obviously you guys have done it, and you've done it successfully, until I'm actually 500% confident that I'm really all in, and I really am not going to screw up. Obviously, it's impossible to predict. 100% impossible. But again, the same guy that I was on the call with earlier today from LA, he tells me, we were talking about different things, and he's like, Isaac, I don't work for you. I don't work for my partners. I don't work for anybody. I work for my investors. I need to make sure that every single last penny that they deserve, or at least what they potentially could get, is going to be in their pocket. So listen, guys, you've done tremendous things in the space. You continue to do beautiful things in the space. I appreciate you guys. Thank you so much for coming on. This was a fabulous, fabulous conversation. Hey, everyone. Thank you so much for tuning in to another episode of the Stage Debate Podcast. This was a fun one. Thank you so much to our sponsors again. And like I said, this was the grand finale. So tune in a few weeks from now for the hotel podcast that's going to be dropping. It's going to be very exciting. Learn about a new industry. Learn the ins and outs. Let's go. Thank you.